Hello, welcome to International Finance. My name is Matthew Winter, and I am so excited to be teaching you. So, a little bit about myself. My PhD is in finance. The area that I do research in is international. I've taught for quite some time now. I've worked for 2 years at the SEC. I was a visiting scholar in the Office of Litigation Economics, and I wrote the rules for investing in private capital markets. It's a $2 trillion market. And the area that I do my research in, what I publish in, it's international. I look at how firms behave around the world. I look at how investors move money between countries and what investors care about in the US and abroad and all of that. So I'm very excited to be teaching this class. My office hours are going to be via Zoom Tuesday from 2 p.m. to 3 p.m. This week, we got a little bit jammed up because of the weather and the school closure, but going forward, my office hours will be Tuesday, 2 p.m. to 3 p.m. The webpage is going to be accessible through Blackboard. What you'll find on the course webpage will be our announcements, our lecture notes, problem sets. Everything's going to be on the course webpage. There, you'll also see the syllabus. And just to explain a little bit about the course structure, the course materials. So we'll have the required textbook, which is the um, McGraw-Hill. The link is available via the syllabus. Again, older copies, international copies are all fine. Most of the content hasn't really changed that much. And we're going to be using the book as a base, but not as the end all be all for what we discuss. You will have problem sets. These will be individual. They're really for you to practice and apply the material so that nobody gets lost along the way. And then you'll also have empirical cases. So every 2 weeks or so, you'll have to retrieve some data, do some analysis. You'll be doing these problems in Excel, and you can work on these together within your study groups. You'll be able to access the relevant materials on the course page, so you'll see what the assignments are. And then you'll also be using real data to produce a professional memo for your final project. And again, the memo, the case that you'll be doing, it's looking at this really interesting puzzle that we have in international finance. And again, it'll be done through your study group. What's expected of you? You complete the required readings for the lecture. The required readings are going to be the chapters from the book or other assigned readings throughout the semester. That might be a news article or a scholarly article that I think does a good job of explaining something that we're interested in. The suggested but not required stuff that you may also want to tune into probably be financial podcasts. It's a really easy way for you to stay attuned to what's happening in markets and in the economy without you spending years and years and years getting a PhD like some of us have done. Okay, so you do the readings, you do the problem sets, you do the empirical sets, the case study. The problem sets, again, those are going to be individual. Your lowest is going to get dropped. The empirical sets, your lowest empirical set will get dropped. So I think we might have 6 in the syllabus, so maybe 5, your top 5. Problem sets, every week we'll have these. Your lowest one gets dropped, so don't even worry about it. And then you also have your case study and your memo, which you'll do within your study group. The empirical sets and the case studies are submitted in groups, but make sure that you can still understand and do the questions yourself. And of course, I expect you to comply with the Stony Brook Honor Code. What tools are we going to be using? We're going to be using finance. So we're discounting cash flows, NPV, capital budgeting, CAPM, WACC, stuff you've seen before. We're also going to be using accounting. So we're going to look at balance sheets, income statements, statement of cash flows, and then we're going to be applying statistics when we get into any discussion of portfolio choice or any discussion of decision under uncertainty. We're going to have to look at mean, standard deviation, how much does something move around, and then covariance. How do these things move around together? And then all of this is going to be laid on top of the foundation of economics, supply and demand, asymmetric information. Maybe you know something that I don't know. And then also competition. We're going to be looking at how firms and investors are going to be competing to get capital and to supply capital. What can you expect of me? You can expect me to return you a high ROI. I'm going to give you a high return on your investment. It's not just about making sure you get a high grade in the class. Really, the goal is for you to be able to take the knowledge that we discuss and apply it outside of the classroom. So if you're up for a job interview, an internship, or if you're trying to network, I want you to have the tools and the capability to take these really interesting phenomena that happen in our global market and explain them in simple, easy to understand words. So we'll work quite a bit to make sure you understand some of the theory. We'll do plenty of practice problems to make sure that you understand the mechanics, the math behind it. And then with the empirical cases, with the Excel work, really the goal is for you to put a bow around it and be able to apply these concepts to the real world, because this is a professional school. So the way that we get there is with you asking plenty of questions about stuff that you don't understand, and you also working within your study group to have a team within the class that you can compare notes and compare how you're approaching problems to. What is this course about? First, we're going to make sure we understand the key concepts of the international financial system. So before we get there, the next lesson will be a review of the time value of money and some of the valuation equations. Then, once we kind of have that established, we're going to look at some of the interesting stuff for international finance. So the easy way for us to get there is going to be with foreign exchange, with the capital account, the current account, and that'll kind of get us to understand a bit more about trade and some of the political issues that happen with trade wars. Once we have that grounding, we're going to jump into the decisions of the firm. So point two, we're going to look at how firms make international financial decisions. The first thing we'll jump on will be corporate governance. So we'll talk quite a bit about agency. Agency is an easy way of saying that I worry that what you're doing may not be in my best interest. So we'll look at agency concerns. We'll use financial options as a way of hedging our exposure to foreign exchange and commodity risk. We'll use real options. Real options, if you haven't heard of it, it's a way of looking at the firm's decision to delay an investment or to expand an investment or to just wait. We'll look at how all of those real options are an easy way for us to understand foreign direct investment, the decision of the firm to go international, the decision of the firm to open up a new plant or to expand facilities in another country. And then the last thing we'll talk about within corporate will be the international cost of capital. So we'll look at what happens if a firm is listed on many markets. We'll try to understand whether or not investors are holding assets that are just in their country or they're holding assets that are all around the world, and how that's going to affect the manager's decision to raise capital and where the manager will raise capital. Once we have a pretty good understanding of the problem that financial managers face, we're going to shift to investors. So we'll do a slight review of portfolio choice. Really, with portfolios, we kind of have a few components. We've got mean, our expected return on average, how much are we making? Variance, how much does it move around? And then covariance, all the assets that we put inside of our portfolio, they all move around. So we want to know how they move around together. And once we have that idea established, we'll look at different risk factors that people have shown seem to matter to investors. So what's our goal with that? Our goal is to understand market segmentation. Market segmentation is an easy way of saying that these markets are all separate. So if instead of us having this one big global capital market, we have many smaller national markets, then that's going to affect our investment strategies a little bit differently. So we'll look at that. We'll look at international factor models. Once we build all these models, we're going to price some assets. We'll look at a foreign exchange investment strategy known as the carry trade, and it'll be a great way for us to understand limits to arbitrage. Hopefully, we can use that to springboard into some other limits to arbitrage that we see more generally in finance. You can think about the GameStop run that just happened. And then lastly, if we're able to, we can get into international bond markets and sovereign debt. And there's this really cool thing called the sovereign ceiling, which is just this interesting puzzle that we have within international finance. Okay, so what makes international finance interesting? Well, countries can really do their own thing. Countries have different currencies, economic policies, social policies, taxes, investor bases, you name it. Things can be so different across countries. All of those differences are going to affect how managers run the firm and how investors are going to supply capital to the market. So the key features that we'll talk about in this lecture are going to be foreign exchange risk. We'll introduce some market frictions so we can be more familiar with the language. And then we'll talk about how this can expand the opportunities that you have as a firm and as an investor. So let's orient ourselves. In the center of the circle, we've got our owners, our shareholders. These are the people that own the firm. These are equity holders. The next circle that we have are our investors, and that's going to include our shareholders, our debt holders, banks, anybody that's lent capital or supplied capital to the firm. And then the outside ring, the biggest circle, are going to be our stakeholders. Now, our stakeholders are going to include our owners, our customers, our suppliers, our government, our community, basically any person or any group that's going to be affected by the actions of the firm. So why is that important? Well, the first thing we talked about is foreign exchange risk. Now, the key idea with foreign exchange risk is that exchange rates can be volatile. They can move up and down quite a bit. So if I'm a manager and I'm risk averse, i.e., I'm somebody that doesn't like risk, or if I'm an investor and I'm somebody that doesn't like risk, then I may want to hedge this foreign exchange risk. The reason why we're thinking about stakeholders as we kind of discuss this is because you can imagine that the foreign exchange risk that we face as a firm or as an investor, that our feelings might be different if we were different stakeholders. So to make sense of that, if I'm a supplier and I'm facing a foreign currency devaluation, I might feel differently than if I'm a customer who's facing a foreign currency devaluation. So the whole point is that these risks that we face, we might feel differently about them and then have different actions that we take depending upon how they affect us as a firm or as an investor. The next thing we talked about were market frictions. So the first market friction that we'll look at will be corporate governance. And really, it's a great way for us to understand these conflicts of interest that occur within the firm. The easiest one to understand is probably agency concerns. And again, I'm worried that you're not doing right by me. I'm an investor, I'm giving you money, and I worry that the manager's definition of doing well might be different than my definition of doing well. And those differences, those conflicts of interest, are going to be true across the board for different types of stakeholders. So if I'm a shareholder, what might be good for me might be different than employees or a manager. Even amongst shareholders, we could have really, really large shareholders who have a controlling stake in the firm, and they might want different things than smaller shareholders, which is something we'll see next. And this is also true across investors. So if I'm a shareholder, I may want the firm to be very risky. If I'm a debt holder, I may want the firm to be very safe, and etc. We also have different frictions. So like we mentioned earlier, we have market segmentation. Capital is costly. It takes time, effort, energy, and money to raise money. So that's going to affect the way that we think about firms behaving. We have limited information. We have asymmetric information. We have political risks, we have taxes, we have financial distress. It's really, really difficult to have bankruptcies cross international borders. So that's going to affect the way that we supply capital. And then we also have irreversibility. Some of the actions that we'll take as managers, we can't easily undo. All of those different frictions are going to affect the way that the firms behave. So what do these frictions do? For firms, these frictions can affect firm value and spill over to other financial decisions. For example, agency. If I'm really worried that these managers who we've hired aren't doing a good job, then I'm going to have to take time and effort to monitor them. Monitoring costs money. It takes time and energy. It takes my attention. It's going to be worthwhile for me to monitor these managers if I'm a large shareholder versus a small shareholder. Think about it. If I've got 100K invested in the firm versus $100, I'm going to feel differently about putting the time and energy necessary to make sure the managers are doing a good job. But if you are a large shareholder, you're also giving up some diversification benefit. So now, if a lot of your wealth is invested in one firm, you may want that firm to behave differently than you would if you were invested in a lot of different companies, right? You may want the firm to be a little bit safer, i.e., less risky. Okay, well, safer firm means safer cash flows, all things held equal, potentially lower beta, and a lower beta is going to lower the firm value. So again, the point is that these frictions can spill over and affect other financial decisions. For investors, these frictions can also increase risk and potentially limit the opportunity to diversify. Currency devaluation is a great example. So on paper, I could make a ton of money investing in a different market. But if that market experiences a currency devaluation, then the actual return that I walk away with might be wiped out. Agency concerns can reduce diversification benefits. We just went through that example. Whereas a shareholder, I may end up deciding to hold way more shares in a company than I would otherwise because it's going to be important for me to monitor the managers. And then bankruptcy laws are really hard to enforce across borders. So if I'm a debt holder, that's going to increase the risk that I face because instead of me being able to loan out to supply capital to many different firms from all around the world, I might be limited to firms that are in my country that likely face the same risk and the same types of shocks. So that's going to increase the risk that I face. Let's look at an example of Nestle. Nestle is a company you're hopefully familiar with. You may not be a big chocolate eater like me, but at least you know the name. What did Nestle do? Nestle had two different types of shares. So they had shares that were only available for Swiss residents and then shares that were available for foreigners. In November 18th, 1988, Nestle decided to lift restrictions on these shares and basically allow these registered shares to be held by foreigners as well. So, what do you expect happens? Well, as you would guess, the price between these two shares quickly narrows. They end up trading similarly. What's the point of showing you this? Hopefully, what you can see from this graph is that when we had a segmented market, we have prices that are very different. So the firm's cost of capital is being affected by this market segmentation. When we eliminate the market segmentation, when we integrate our markets, you can see how the prices are very similar and start moving in lockstep. Okay, so when we reduce these barriers, when we remove some of these market frictions, we can expand our opportunity set. For managers, the number one thing we'll first think about is the capital market. So if I have access to investors in different countries, I can access them through cross listing by listing on another exchange. I can use a euro bond, i.e., I can raise capital in this country and send it to another country with a different currency. I can access different banks. I can have a larger shareholder base. All of that is going to reduce my cost of capital. And the same is true of my product market and my labor market. From the perspective of an investor, I can access assets with different exposure to the risk that I face at home, which is going to work in two ways. One is that I can supply capital that has different rights and different enforcement rules. So we see this quite a bit. We'll see investors from markets that have very, very weak shareholder protections come and invest in the US, where companies that are publicly listed are going to be compliant with really strong shareholder protections. And ultimately, if I have more diversification, so if I'm able to invest in a lot more things, I can reduce my risk overall and I can potentially increase my returns for the same level of risk. So that'll be the portfolio exercise that we do together. We're going to optimize portfolios when we get into our investment section of the class. So what's our goal? Primary goal can be to maximize shareholder wealth, which means making the stock price go as high as it can. But in many countries, the focus is on stakeholders. So that could be employees, banks, suppliers, it could be the business group, the kairatsu or the chaebol, depends. So we're going to take the position that firms should always behave ethically, because shareholders are also members of society. Investors are also members of society. So we're always going to be assuming that firms should behave ethically whenever we discuss anything within international finance. But it's an important point that because we have different values across countries, what is right and what is deemed as the best may not hold true for everybody. So we'll keep that in mind as we discuss. Stock price 101. So what do we have? In our numerator, we have free cash flows. And just to explain, you can see the little time subscripts, the 1, 2, all the way to infinity. Those are different time periods. So the way that we'll always be reading these discounted cash flow examples is period 1 starts next period. So next period, we're going to have a free cash flow, and we're going to discount that free cash flow at 1 plus the WACC. Then 2 periods away, we're going to get some free cash flow. And you can notice how we're discounting that cash flow at 1 plus the WACC squared because it's 2 periods away all the way through infinity. So what is our free cash flow? Our free cash flow is basically what's left over for investors. So it's our sales, less our operating costs, less the taxes that we pay because we're going to be in a country, so we're going to pay taxes, and then less what's required for our investments in operating capital. Basically, if we have to have some capital expenditure or we have to have some costs to kind of keep our company going. So once we've done all that, once we've paid our operating costs, our taxes, and our required investments for our operating expenditures, or operating capital, what's left over goes to our investors. In the denominator, we have the WACC, which is the weighted average cost of capital. We'll look at that in a second. And in our denominator, that's where we'll think of sort of the third part of our course where we talk about investors. We're going to really try to understand how investors are assigning a discount rate to these different cash flows. So let's think about our friction. One of the frictions we said was agency. If I'm worried that managers are going to be stealing money from the firm, that means that the free cash flows are going to be lower. So if the free cash flows in period 1, 2, and all the way through infinity, if I'm expecting those are going to be lower, you can see from the equation that the value of the firm, the stock price, is going to be lower. Okay, we said that with market segmentation, as an investor, I'm going to be facing a lot of risk and I won't have the opportunity to diversify. Let's think about that. If as an investor, I'm facing a ton of risk and I don't have the opportunity to diversify, then the required return, the discount rate that I'm going to be putting on all of these financial assets is going to be bigger. I need a bigger return to compensate me for bearing more risk. Well, let's look at the equation. If I have a bigger discount rate, that's in the denominator, the WACC, you can see with a bigger discount rate, the firm value is going to fall. The more of a required return that I demand, the lower, the lower, the lower the price of the stock today. So let's look at this WACC. Our WACC is the average rate of return required by all of the company's investors. It's going to be affected by the capital structure. So how does the firm mix the debt and equity? What are prevailing interest rates in the economy? How risky is the firm? What's the firm engaged in? And definitely by investors' risk appetite. So, what's the overall market attitude towards risk? You can imagine that if I'm a firm and I'm facing one pool of investors in my country, and there's another group of investors in a different country that might have a different risk appetite, I would love to be able to access them. So that's why we'll talk about cross listing and ways that firms try to access the supply of capital that's not only held within their country. So let's get through a brief course outline. Part 1, we're going to do international financial system. We'll do a refresher on the intro to finance. We'll discount cash flows together. Amortization, we're basically going to pay off a loan together. And we'll use the appropriate discount rate for NPV, all of it. Once we have that established, we're going to get right into international finance. So you'll read chapter 1, which provides a really good background on international finance. And then we'll get into the balance of payments, the capital account, the current account, recent developments in trade. And then we'll look at the international monetary system and we'll talk quite a bit about Brexit, which is something that happened very recently and I think provides a good way for you to understand how these things all intersect, the political, the economic, the financial, all of it. Part 2, will be international corporate finance. So here we'll talk about corporate governance and why we have corporate governance, because we have the separation of ownership. The people who own the firm are often different from the people who run the firm. So we have all kinds of conflicts of interest, and we'll look at ways of addressing that, the mix of debt and equity, all of it. Then we'll get into financial options as a way of hedging our foreign exchange and commodity risk. We'll look at real options. Again, that's the option to wait, the option to delay, the option to expand, etc. We'll look at that as a way of understanding foreign direct investment. So this is when a company decides that they want to build a new plant or expand or build a new facility in a different country. A great way for us to understand that is through the flexibility that the managers are trying to achieve with their decision making. So is it better for me to wait a year to do this? Is it better for me to do this right now? We'll look at those kinds of things. And then the last thing we'll do with corporate is we'll get into market efficiency, the cost of capital, home bias. Home bias basically means that investors' portfolios are super concentrated in stocks in their own country, which, as we've talked about, can affect your risk appetite. And then we'll get right into investment. So we'll do portfolio choice. We'll go through market segmentation. We'll ask what risk matters to investors. So there we're going to use factor models, and hopefully, time permitting, we'll be able to look at some very interesting cases of the limits to arbitrage with foreign exchange. So we'll value foreign exchange. We'll talk about the carry trade. We'll get into the Mexican peso crisis, and we'll look at other periods when the limits to arbitrage have affected these portfolio decisions. And then the last topic that we'll hopefully be able to cover will be international bond markets. So we'll look at the sovereign ceiling, which is a fancy way of saying that it can be really, really tough for companies to have a higher credit rating than their country. So if I'm in a country where the credit rating is relatively low, you can imagine that that's going to affect the cost of capital that I face as a firm. So all throughout the semester, we're going to be looking at different applied topics. We're going to be using the financial press as a way to get those applied topics right up in our lectures and right up in our discussions. And then, of course, there are things that are just super interesting, like M&A and Brexit and our current pandemic. So we'll try to sprinkle that throughout the semester. The topic of this week, review the time value of money. Next week, we're going to get into the role of the balance of payments. What does a trade deficit mean? We'll look at the trade war. How does uncertainty over tariffs and trade limits affect a firm competing with an importer or one dependent on exporting? So we'll look at these different stakeholders and see how they're affected by these different trade ideas. So the big thing, next lesson, please review the time value of money. I'm going to put up that lecture. There are plenty of examples for you to work through. I'll also post the solutions for you to look at so you can work through the examples and get a good idea. And then make sure you read chapter 1, which is the intro to the international financial system. Chapter 1 provides a good overview of everything from multinationals to the international monetary system. It's just a good way to get familiar with the topics we'll be going through in the course. I look forward to teaching you, and yeah, that is it for now.